welcome to Market Matters, our monthly podcast bringing you big picture insights from leading investment specialists, exploring the opportunities and challenges shaping today's markets. Today's guest is Sophie Huynh, Portfolio Manager and Strategist at BNP Paribas Asset Management. Sophie, many thanks for joining us today.
Thanks for having me.
So perhaps you could start us off with a 60-second or so overview of your path into asset management and maybe any key challenges you might have faced along the way.
So I started in the sell side. So I was at Société Générale when I started my career in 2013 and started as a cross-asset strategist. So I started cross-asset immediately very early on and then took on the US equity strategy mandate. So that was very challenging as well. I think the lesson I learned from these years in the sell side was I started marketing very early. So I started to go see clients at 25 and I looked freshly out of university. And I think the advice that I got and also what I tried to do was whatever you're saying, have a framework justifying it. So that basically made me develop a framework on a cross-asset basis using a quantamental mentality and mindset to explore markets and try to find investment opportunities. And I think it's still serving me at the moment in the buy side, so at BNP Asset Management, first as a strategist and recently as a portfolio manager.
Great, thank you. Very interesting to hear all about that. I'd like to move on to portfolio allocations next and start with a perennial question faced by investors. Does the 60-40 portfolio still have a place, do you think, or perhaps 2022 exposed the risks of relying too heavily on a negative stock-bond correlation?
It's been very challenging for a 60-40 portfolio, and I think we need to go back to where the equity bond correlation have been and trying to understand where it's going to settle. So if you look at the equity bond correlation since the 80s, it's been through two stages. So from the 80s, 70s until 2000, where the equity bond correlation was positive. So equity bond prices positive. And that was due to an environment where growth and inflation were moving in opposite direction. And where the environment was dominated by a negative supply shock. And that was making central banks work a bit harder. And then you got 2000 until COVID, where the equity bond correlation shifted negative. That also marked the entry of China at the World Trade Organization in 2001. And we moved in an environment where the equity bond correlation was negative because growth and inflation were moving in the same direction. It was a positive supply shock environment. And central banks just had to hike in an overheating environment and vice versa. So that was easy. Then COVID hits. It was like this supply shock, inflationary environment with this massive fiscal support. I think it was very challenging because the equity and bond returns were both negative. So there were nowhere to hide. At the moment, I think what's very striking, and at least for the past 2 years, is that the equity bond correlation is flipping around. Equity positive, negative, equity positive, right. Negative. So it's very hard for 60-40 portfolio to basically know where you're going to settle. And I think the forces that are going to drive the equity bond correlation going forward or like mixed, and you need to take a stance on that. So positive supply shock where you have AI and you have this productivity gains. And then on the other side, negative supply shock where all the problems around supply chain, but also populism that might make the equity bond correlation more positive. So, and then on top of it, the fact that the equity risk premium is very low is making equities very sensitive to any rates move. So I think at the moment, compared to where we should be at the stage of the cycle, so we're more late cycle if you look at classic macro regime models. So it's still in expansion, potentially going to slow down, but feeling a bit more late cycle. You would have more bond allocation historically, but that's not the case at the moment. And I think that's why AI and tech stocks are rallying so hard, because there's a perception that they somewhat replace duration through the long duration exposure and the fact that their earnings are so far in the future that they provide some long duration exposure in the portfolio. So to some extent, a 60-40 portfolio would look like more like a 80-20 or 70-30, but with more tech stocks that replace some of duration allocation.
I think, as you say, it's very good sometimes to take a step back and look at the longer term picture than focus on the last kind of 10 to 15 years. And staying on the topic of portfolio construction, what about alternatives? Do you think investors should treat them as core diversifiers or perhaps more as tactical tools for riding out short-term volatility?
We think they are core and essential at the moment, especially all the talks about Fed independence, rebuilding of term premium at the back end of the curve. Even if it's very consensual, you cannot really deny it. So on our side, we've been long gold for at least 2 years now. Long gold miners. We also have copper. And we think that long-term structural, they were good to gear to as a replacement for duration, but also as a way to be exposed to potential risk around currency debasement, populism. So we think it's good to have them. And that's why we've been long for a while.
I think we're going to come back to gold later on in our discussion. But I'd like to dive into regional allocations next, and I'd like to start with the US, probably the natural place to start. Do you see US exceptionalism perhaps fading, and how do you see the narrative for the US economy over the next 12 months or so?
I think if you talk about US exceptionalism, I think you need to disentangle two things. The first one is US exceptionalism through the tech stocks and the AI thematic. That remains here, and I think it's still going to have some legs with an expansion of the AI theme towards like other regions. So in Asia, for example, where you've seen Korea, Taiwan, Chinese tech performing super well. But the other side is US exceptionalism, as in US economy outperforming the rest of the world. And I think that has totally faded. So if you look at the premium of the US dollar compared to interest rate differential, in 2022, it was around 10-15% premium. That has totally faded. So in my view, the classic US exceptionalism way, I think it's not there anymore. So we cannot really talk about this.
Great answer to the question. Thank you. Europe has also performed quite strongly this year. Are there any sectors that you're particularly bullish on, or maybe areas where you'd perhaps be more cautious?
I think it's really interesting when you look at Europe. So early this year, it has really outperformed US stocks. But then you got like a flip around Q2 when US earnings started to be upgraded with this tariff relief. When on the other side, on Europe, I think the strong euro, but also the uncertainty on tariff didn't really help in terms of how much is going to impact earnings. So I think going forward, and what's really interesting when you start to look at the macro and micro data in Europe is on the macro side, you started to see soft data really picking up. So if you look at PMIs, new orders to inventories, people attribute that to the front loading of orders, but I think there's more than that. And if you look at countries like Sweden that are very interest rate sensitive, you're actually starting to see signs of pickup. So I think the fact that the easing cycle started more than a year ago now is starting to feed into financial conditions through the real estate sector and potentially through a bit more confidence on the consumer side. And then if you look at the potential impact of China anti-involution policy on European equities, I think what's super interesting is if you look at analyst revision model in terms of earnings for European sectors, you start to see signs of like green shoots on basic resources, chemicals, and autos. So basically sectors that could potentially benefit from less competition from Chinese cheap goods. So potentially a recovery and more profit margins from here. So overall, I think if you look at European equities, looking at CAC 40 versus DAX could be interesting. CAC 40 because it's more exporters. If you have another boost from China, another fiscal package in China announced in October, that would definitely help. I think in terms of infrastructure, but also defense spending is still interesting, good to have in portfolios. And on the small cap side, we're also looking if there are green shoots of recovery that we're currently seeing in soft data would potentially translate into hard data. But Europe is definitely a place you need to look at.
And finally, China, which I think is still quite a tricky call. There's structural challenges on one side, but it has had strong equity performance this year, partly thanks to the deep-seek effect. Do you see the case for increasing allocations to China?
I find it a bit ironic, as in, I think 2 years ago, no one wanted to touch it, yes. And now it's so consensual. So in terms of the Chinese equity allocation, we had Chinese equities for at least a year now. So invested across A, H, and China Tech. We've been quite bullish on it. We took a bit of profit last week, given the bull run we've got. But I think it's part of our framework. We believe in Chinese equities. We think the trend is here. But if you follow our 4-pillar framework, which is fundamentals, policy, sentiments, and valuation, you want to play the range as well. So we think that in the short term, it might have gone up too fast, and we want to play that. But clearly in the long term, we think we need to have Chinese equity allocation as a classic allocation to have in the portfolio.
Zooming out from equities now, currency has crept back into conversations. What's your take on where the US dollar goes next year and what that means for portfolios?
So the US dollar, we have been bearish since, I would say, November last year, which was a really non-consensual call because of the super bullish positioning, because of what I said earlier, the US exceptionalism premium that was already well priced. Now, if you look at where positioning is, I think it's more neutral, bearish positioning and very consensual to have a bear dollar trend next year. If you look at where the dollar should be heading and why, the fact that the US dollar is more correlated with interest rate differential at the moment is making our life a bit easier. So at the moment, you have 2 Fed cuts priced by the end of the year, and the Fed to go back to 3% by December 26. For the dollar to go down more from here, I think you need to have more cuts priced, so let's say a 50 bips cut, or the Fed to go below 3% earlier. And that requires the US economy to go through a nonlinear collapse, so meaning a recession kicking in. And for now, we're not seeing that. So for next year, the view is going to be much more a creep lower in the US dollar. But that's great for alpha, because that means that you're going to have much more differentiation across the FX spectrum, driven by domestic policies, so dollar versus other currencies. So thematics such as carry trades, commodity-linked currencies, high beta. So I think there's going to be much more ways to play around the FX complex rather than, let's go long or short the dollar.
Okay, and you mentioned gold earlier, which keeps hitting new record highs. I think it's hit some more in the last month. Do you expect central bank demand to keep supporting gold prices, or is there downside risk? And stepping back a little, how should investors think about broader commodity opportunity, do you think?
So gold has been really a puzzling one. So if you try to model gold price with a simple regression of real rates, break-evens, dollar, and VIX, gold price should be around 2,400.
Okay.
It's nowhere at this level, but it's clear that central banks buying, but also people trying to replace duration in their portfolio has been behind the bull run of gold. And let's say that China announcing that they want to be a custodian for foreign central banks'
Yes.
gold holdings is also helping. I think going forward, the trend on gold price is here to stay. So the forecast that we see around 4,000 or 5,000, I think makes sense. But it's more what's going to happen between now and there.
Right.
So we want to monitor positioning quite closely. I think what's been driving gold price recently has been trying to take more into account the left-down risk in portfolios instead of being long classically treasuries or bonds, given all the fiscal jitters that we've been going through, but also ETF buying that have been really supportive. So overall portfolios having gold, I think, makes sense much more than in the past.
And one final question, if we may. What's the best piece of investment advice you've ever received?
So I think it was when I started working from my former manager, Alain Bokobza, the head of asset allocation at SocGen. I think he managed to outperform everyone in 2007. I think the piece of advice he gave me was, if you don't understand something, don't buy it.
Right. Very good. And on that note, Sophie, many thanks for joining us today.
Thank you. Thanks for your time.
And if you'd like to read more market insights, please head over to the Kepler Trust Intelligence website, and we hope you join us again next month for another episode of Market Matters. Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorised and regulated by the Financial Conduct Authority.